All right, let's get right into it. Today, we're essentially building a battle plan. We're going to dive deep into the Brazilian stock market, and we're going to hunt down the 4 hidden enemies that can absolutely sabotage your portfolio. And, of course, the most important part, how to beat them.
So, I want you to think about this for a second. When you look at Brazil's stock market, the B3, what do you really see? Is it this incredible gold mine just packed with emerging market potential? Or is it a minefield, loaded with volatility and risk? Honestly, this is the question every single investor has to ask themselves.
And the truth is, well, it's both. Of course it is. The real key to finding that gold isn't just about trying to pick the next big winner. No, it's about having a map to navigate all those very real dangers. And that's exactly what we're going to do right here, right now. We're drawing that map.
Okay, so let's really get into it. The Brazilian market, it's a classic high-stakes game. You've got this incredible potential for growth, but it is tied directly to some pretty massive volatility. We're talking about economic shocks, political shocks. These things aren't just a what-if. They are a core feature of the landscape. And your success, it's going to depend entirely on how you prepare for them.
Now this quote, it completely reframes the whole problem, doesn't it? It basically says that volatility isn't some kind of bug in the system. It is the system. It's the very thing that creates opportunity. It's this powerful force that literally transfers wealth from the impatient, emotional investors over to the ones who are disciplined and prepared. So it really just boils down to one question. Which side of that transfer do you want to be on?
Okay, time to meet enemy number 1, systemic risk, or as I like to call it, the market tremor. And trust me, this is the big one. It's like an earthquake that shakes the entire market. It hits everything all at once. And here's the kicker. You simply cannot diversify your way out of it.
So to really wrap our heads around these tremors, we need a specific tool. And that tool is called Drawdown. It's a simple idea, but it can be pretty brutal. It just measures how far your investments fall from their absolute peak down to their lowest point during a crash. It's the number that tells you exactly how bad the damage really is.
And this isn't just theory. Look at this. This is how real it gets. These are historical drawdowns for the Ibovespa. I mean, just look at the COVID shock. The market just cratered, falling over 31%. But here's the thing you really need to focus on, especially if you're a long-term investor. It's not the drop itself. It's the time to recovery. The real question is never just, how far did it fall? It's how long is it going to take to get back to even?
All right, let's move on to enemy number 2. And honestly, this one might be even more dangerous. I call it the hidden sinkhole. This is what we call non-systematic risk. So it's not a market-wide earthquake. No, this is way more insidious. It's a sinkhole that suddenly opens up under one single company, and it can swallow your money for good.
So let's be really clear about the difference here, because it's absolutely crucial. A market tremor, it's like a bad storm. It's rough, but you can wait it out. A hidden sinkhole, though? That can be a one-way trip to zero. We're not talking about a temporary paper loss anymore. This is a real loss. And that capital, it might be gone forever.
So you might be wondering, how does something like this even happen? Well, a classic example is something called the delisting trap. Here's the playbook. The whole market is down, right? So a company's stock is cheap. The main shareholder, the one in control, sees an opportunity. They launch a lowball offer to buy back all the shares and take the company private. We saw this with companies like Carrefour Brazil and Wilson Sons. And what happens to you, the small investor? You're basically forced to sell at that crappy price. And just like that, what should have been a temporary market dip becomes a permanent, painful loss for you.
So how on earth do you fight something like a hidden sinkhole? Well, your weapon is actually pretty simple, but it's incredibly powerful. Diversification. Think of it as your ultimate insurance policy. If one of your stocks happens to fall into that sinkhole, a properly diversified portfolio means your entire net worth doesn't go down with it. It's that simple. Okay, let's talk about enemy number 3. This one, it's sneaky. It's the silent thief. This enemy isn't going to cause a big, dramatic market crash. It's not going to bankrupt a company. No, it just works quietly, in the background, skimming a little bit off your returns, year after year after year. I'm talking, of course, about costs, specifically management fees.
Let's just put a number to it, 2%. That's a pretty standard annual fee you'd see for an actively managed fund in Brazil. And you hear that and you think, 2%? That's nothing. It sounds so small, right? Almost insignificant. But let's see what that silent thief can actually do when you give it enough time.
And here it is. This is the absolutely devastating anti-compounding effect.
That little 2% fee, it doesn't just reduce your return by 2% each year. Oh no, over 20 years, it can eat up almost 40% of your potential gains. Why? Because the fee isn't charged on your profits, it's charged on your total investment. It actively works against the magic of compounding, sabotaging your growth from the inside out.
So this leads to a really important, kind of tough question. You're paying that high fee for expertise, right? For a manager who's supposed to beat the market, but are they actually earning it? The data here is, well, it's shocking. In Brazil, only about 1% of active equity funds consistently beat the main index, the Ibovespa, over the long haul. Let that sink in.
And that brings us to our fourth and final enemy. And I gotta tell you, the evidence is overwhelming on this one. This is the most dangerous enemy of all. It's not the market, it's not a specific company, it's not even a fee. The biggest enemy is the one staring back at you in the mirror. It's the enemy within, your own psychology.
So, let's look at the first one. Confirmation bias. You know what this is. It's our natural tendency to just seek out information that confirms what we already believe. You buy a stock, and suddenly you're only reading the articles and watching the videos that say what a genius move you made. This leads straight to overconfidence and, you guessed it, portfolios that are way too concentrated in just a few bets.
Then you've got herd behavior. Look, we're social animals, right? That impulse to just follow the crowd, it's incredibly powerful. It's what makes us jump on hot stocks when they're at the very peak of a bubble. And then it's what makes us panic and sell with everybody else when the market hits rock bottom. It is literally the perfect recipe for buying high and selling low every single time.
And finally, there's loss aversion. This is a big one. Psychologists have shown that the pain of losing money feels about twice as strong as the pleasure of making the same amount. What does that do to us? It makes us cling to our losing stocks, just praying they'll come back, instead of doing the smart thing and cutting our losses. This is exactly how a small, manageable mistake turns into a catastrophic one. Okay, so we've met the four enemies: the massive market tremor, the treacherous hidden sinkhole, the sneaky silent thief, and the most dangerous of all, the enemy within. We've identified them. Now it's time to build our integrated battle plan to defeat every single one of them. So here it is. This is your arsenal. To beat the enemy within, you have to build a rigorous data-driven process, something that takes your emotions out of the equation. To avoid the hidden sinkhole, your number one defense is to diversify and diversify broadly. Make sure no single company can blow up your whole plan. To stop the silent thief, you have to become obsessed with costs. Focus only on your net returns, what you actually keep. And finally, to survive the market tremor, you have to allocate capital that is truly long-term, and then you have to practice strategic patience. See, for every enemy, there's a specific weapon. And when you put it all together, this is what it looks like. You see, successful investing isn't about some secret formula or one magic trick. It's a complete, holistic approach to managing risk. It's built on four solid pillars: your own behavior, your portfolio structure, your cost control, and your time horizon. You get these four things right, and you've essentially built a fortress around your capital. So, I want to leave you with this one last thought. The market is always going to be volatile. That's just what it does. It's its nature. The one thing, the only thing you can truly control is your strategy. And that strategy has to be stable, disciplined, and tough. So the real question isn't about the market. It's about you. Are you prepared?